All right, I want to make a quick video on the new bullish positional strategy that I'm going to be sharing in the Discord. Just wanted to make like a strategy 101 slash like what the hell am I talking about? So I'm going to be going over the setup, who would benefit from this strategy, and then my purpose, and then I'm going to be talking about the equity of choice for the strategy. So let's get into the setup. I'm going to be using my back testing document to kind of portray the setup. So I have my rules over here. It's going to be, about 3 or 4 things on the setup, and I'll talk about why I have these such 3 or 4 things. So the 3 or 4 things, the first one's going to be EMAs are coiled. So why do I have the EMAs are coiled? So it is a weekly, so I'm using the weekly time frame. When the weekly EMAs are coiled, I think it's essentially a proxy for consolidation and overall trend. I noticed in a lot of my Q1 and towards the end of my Q4 trading, I was quite early to a lot of trades, specifically energy. Is my camera's really getting unfocused right now? There we go. Nice. Specifically energy. I think, especially in EOG. I mean, I use VPA quite a bit, and I don't think I had the experience at the time to understand that. Sure, yes, because yes, we do see that buying volume. I failed to realize that overall trend was starting to actually lean bearish, and yes, the institutions are transacting at this level. It's a massive, massive, massive volume print for a small candle. So we know that institutions are buying here, but I fail to realize that we're just clearly not on trend. We're about to have a bearish cross in the weekly, which is certainly no bueno. So it just needed time. So kind of developed this rule. I went back and I looked at all my trades from a little bit towards the end of Q4 last year, excuse me, into Q1 this year, and I just wanted to record. Honestly, just where the weekly EMAs were at the time of entry. So AMGN, I had a winner at AMGN right here. Here was the weekly. The EMAs are fairly coiled, and then here's the result. But APD was a pretty big loser for me. We actually had a pretty nasty gap down on APD, and this one really pissed me off. But sure, I can recognize that yes, there's probably buyers at this level. It's just is that a gear for short-term price action? No, not necessarily. We failed these levels significantly. So just wanted to get a gauge of trend, and then consolidation. And why consolidation? After long periods of consolidation, especially on the weekly, we usually get that expansion. And then I think just because especially with consolidation, your risk to reward is going to be fantastic. I mean, if you're extremely coiled within like a $10 range, and then you get stopped out on that $10 range, let's say you get stopped out for $5, that $5 you lost could have been like a $30 change in price movement. So I think the risk to reward is also really good, and that's why I have the EMAs being coiled. So found that a lot of my losers were just, I was early and I failed to recognize it, and I didn't have a great rule for recognizing that I was early. So I think that's why I really like the EMAs being coiled, and that's why I have that as my first rule. Second rule, we have high volume breakout, low volume pullback. That's a little bit more of just like a VPA thing. So I'm always looking for, breakouts. You should never, ever, ever see declining volume on breakouts. Specifically, if we go take a look at FSLR. On the weekly, I think FSLR, it looks a little concerning heading into earnings for a few reasons. On this candle, first we had that gap. We obviously filled the gap already, but we had that gap, and then the weekly had declining volume. On this, we've been trading in FSLR in this kind of range for quite some time, and then we were just finally starting to break out from this range, and then we saw declining volume. So that's no bueno. We did not want to see declining volume on any kind of breakout, because that's not really a true breakout. That's classically a failed breakout. So I'm looking for high volume breakout to show me true buying. Institutions are really buying at these levels or pushing price up with it. And then I'm looking for a low volume pullback, because that would tell me institutions are not selling off, or obviously you have your short-term profit takers, retail, whatever. But I'm looking for, low volume pullbacks back to, any kind of support or resistance levels. So that's why I have that rule. SR flips, so I do really like risking off of SR flips, but they're essentially just a proxy for where I'm going to be risking my trade off of. So what I mean by that, if we go take a look, so we had resistance over here. These 3 weekly candles could not get over this $80 level. We finally had price break it on high volume. That's always great to see. And then we came back down to this $80 level on this weekly candle, and then we found some really nice strong support right there, as evidenced by that long upper wick, or bottom wick, excuse me. So that's going to be SR, essentially just a proxy for where I'm going to risk my trade off of. Yeah, I think that makes sense. But kind of it'll serve as like my invalidation level. So if we come back down and trade below the support again, that would be very much confirmation of that level serving not as support anymore, but turning to resistance again. So that's that one. The last one is just a rejection or buying, confirmation. I'm looking for confirmation just because price comes back into an area of demand or support or demand. I'm always looking for a weekly, I'll wait that one more weekly close just to I guess make sure I'm right, but confirm the thesis, So yeah, so here's your confirmation candle, like this candle right here. So yeah, I think that is the setup. Quickly, let's go through the first three trades right here. So EMA's coiled, check. SR flip, check, and then high volume buying. I'm looking for the more obvious, the better. I'm looking for high volume spikes on the weekly candle that'll tell me institutions are actively participating in such a move. More obvious, the better. I'm not going to be looking for or stretching for some trying to find some buying spikes. I want to see those buying weekly spikes on the volume. So there's that trade. Let's go talk about this one. EMAs are coiled. Yes. SR flip. Yes. High volume buying. Yes. Good. SR flip. Yes. I said lacking a clean one. I'd rather the more fresh the SR flip, the better. I was saying lacking a clean SR flip just because, this was in March at the time of this trade, and then I was using SR levels back in December. March to December, it's not as fresh, so. More, same thing. It's the support and resistance like theory. Every time it tests support, it gets weaker. Every time it tests resistance, it gets weaker or stronger, whatever. I might have put that ass backwards, but yeah. So SR flip, high volume buying. That's the setup. So that covers the first part of it. Who would benefit / my purpose. So who would benefit? I guess I'll talk about my purpose first. I think that makes more sense. That'll fit into who would benefit. So I wanted a strategy. A little background. I'm going to be graduating college here soon, which is very exciting. But I'm going to be starting full time here. So I want to be a little bit less active in the market, but I want to be taking advantage of catching these big weekly moves. So I really wanted to develop a strategy that was kind of geared towards catching these positional swing, these weekly trades. So I'm looking to be in these trades for however many candles close above the 9 EMA. I haven't talked about exits. I'll talk about exits here in a second. But so I think just developing a strategy where I think I can catch weekly movements with less activity, where I can watch the Friday close chart on the weekends, and then pretty much other than that be pretty have stops in place, but be pretty passive and not as active in the market as I usually would if I had more time. So I think this would be very beneficial to those who do not have a ton of time to trade the markets, but are looking to kind of actively trade them. So that's essentially my purpose for this. I also realized that a lot of my bigger trades came when I had these three rules, heuristics, whatever. So that's my purpose. And then equity of choice, I think there's three options that would be really good, with these weekly trades. If we go look at the back testing, some of these trades I was in it for, almost 20 weeks, that's almost half the year out of your 52 weeks. So I think the average is probably a little more around like 5 or 6 weeks, but I did have some of these where it just didn't break the 9 EMA. So that's my exit strategy. I forgot to mention that, but a weekly candle below the 9 EMA would be my exit strategy. So let's talk about Apple for instance. Trade 4. So Apple trade 4. We were looking for a close below the 9 EMA to exit our longs, and we had this huge positional move, for 22 weeks. So I think the best equity of choice would be, common shares, no theta, no Greeks. I think a credit spread, a farther out. I don't know. Yeah, I think credit spread wouldn't be that bad. I just don't know how far out you'd have to go. Haven't really thought about credit spreads. I was just thinking of leveraging theta, because I think this strategy would be very liable to theta burn, and then I think leaps would also be really good for this strategy. I think it would make sense when the premium's at a good price. So I think leaps, so long term equity anticipation securities. I think. Don't quote me on that. So leaps, commons, or maybe even credit spreads. So leverage theta would be the best for this strategy. But I hope that kind of clarified what I'm going to be talking about / posting with some of these charts here coming up. If you have any questions or comments, I'd be very, very more than happy to elaborate farther. So that'll do it for this video. Thank you so much for watching, and I will catch you in the next one.